There was a moment, not long ago, when Russia's economy appeared unbreakable, a resource superpower stretching across 11 time zones, an energy giant feeding Europe, a nuclear-armed state projecting strength through military force and industrial scale. And at the center of it all stood Vladimir Putin, promising stability, sovereignty, and resilience in the face of Western pressure. But beneath the surface of that strength, cracks were forming. And today, those cracks are widening into fractures that threaten to reshape the economic destiny of an entire nation. When the full-scale invasion of Ukraine began in 2022, many analysts predicted immediate economic devastation. Sanctions were unleashed at a historic scale. The United States, the European Union, and their allies froze hundreds of billions in reserves, cut banks from global payment systems, restricted technology exports, and targeted the very heart of Russia's energy machine. The expectation was swift collapse, but that collapse did not come, at least not immediately. Instead, something more deceptive emerged, a wartime economic surge fueled by extraordinary state spending. Massive fiscal stimulus, military procurement, and defense production pushed factories into overdrive. The government injected money into strategic industries, propped up employment, and redirected trade flows toward Asia. On paper, growth returned. GDP numbers surprised skeptics. Industrial output climbed. The ruble stabilized after its initial plunge. To supporters, this was proof that Russia could withstand isolation. But to many economists, it was something else entirely. A debt-driven illusion, a temporary surge powered not by sustainable innovation or diversified growth, but by war. The foundation of Russia's economy has long rested on oil and gas. Hydrocarbon exports have historically accounted for a massive share of federal revenues. Energy wealth funded pensions, infrastructure, military modernization, and political stability. But sanctions and price caps began squeezing this lifeline. Russian crude, particularly Urals blend, traded at discounts compared to global benchmarks. Shipping restrictions, insurance bans, and financial controls complicated exports. Europe, once Russia's largest energy customer, rapidly reduced its dependence. What had once been a stable, predictable flow of petrodollars turned volatile. Oil still flows, gas still moves, but margins are thinner, logistics are more complex, and revenue volatility has grown. The Russian budget, built on assumptions of steady energy income, now faces increasing strain. To compensate, the state has drawn on reserves, increased borrowing, and raised taxes in select sectors. Defense spending has surged to levels unseen in decades, consuming an enormous portion of total expenditure. Civilian priorities, infrastructure upgrades, healthcare, education have been overshadowed by military demands. War has become the organizing principle of fiscal policy. Meanwhile, inflation has stalked households. Price pressures forced the Central Bank of Russia to raise interest rates aggressively at various points to defend the currency and tame rising costs. Higher borrowing costs, however, choke business expansion and consumer credit. When rates eventually ease, it is often not because conditions are strong, but because the system cannot bear prolonged financial tightening. This delicate balancing act, defending the ruble while sustaining growth, reveals the tension at the heart of Russia's economy. In the streets of Moscow and across regional cities, the impact is increasingly visible. Restaurants and small businesses have struggled with rising costs and weakening demand. Imported goods have become scarcer or more expensive due to parallel import schemes and currency fluctuations. Consumer confidence, once buoyed by state support, has shown signs of fatigue. The early shock resilience is giving way to slower, grinding stagnation. Growth projections have cooled. Forecasts suggest expansion barely above zero in certain periods, dangerously close to recession territory. Labor markets tell another complicated story. Mobilization and military recruitment have pulled workers from civilian sectors, creating shortages in manufacturing, construction, and services. Wages in defense industries may rise, but broader productivity gains remain limited. Skilled professionals, particularly in technology and finance, have emigrated in significant numbers since 2022. This brain drain reduces long-term innovation capacity. A modern economy cannot thrive on raw materials and artillery shells alone. It needs engineers, coders, entrepreneurs, and researchers. Their departure leaves a quieter but profound wound. Another troubling signal has emerged: data opacity. Certain economic statistics have been limited, delayed, or removed from public access. Transparency, once a tool for investor confidence, has been curtailed. When governments reduce economic disclosure, uncertainty grows. Investors hesitate. Analysts speculate. Citizens question. In modern economies, trust is currency, and opacity erodes it. Yet this is not a dramatic overnight implosion reminiscent of 1991. There are no breadlines stretching endlessly across frozen boulevards. Russia still maintains significant foreign exchange buffers. Trade has reoriented toward China, India, and other non-Western partners. Energy continues to generate revenue, even at discounted rates. The financial system, heavily managed and insulated, has not collapsed. This is what makes the situation so complex and so dangerous. It is not a sudden crash, it is a slow constriction. The deeper issue is structural. Years of sanctions have limited access to advanced Western technology, from semiconductors to specialized machinery. Import substitution efforts exist, but replicating high-tech ecosystems is neither quick nor simple. Over time, this technological isolation risks degrading productivity. Military production may expand in volume, but civilian industries struggle to modernize at the same pace. An economy centered increasingly on defense and raw materials faces diminishing diversification. And then there is the fiscal question. War spending at extraordinary levels cannot continue indefinitely without consequences. Deficits widen, sovereign funds shrink, domestic borrowing increases. Each of these tools can buy time, but time is not the same as sustainability. If energy revenues dip further or global prices fall sharply, the buffer narrows, the margin for error shrinks. So is this truly a collapse? Not in the cinematic sense of instant disintegration. But collapse does not always announce itself with fireworks. Sometimes it arrives quietly, through stagnation, declining real incomes, eroding competitiveness, and narrowing opportunity. A nation can remain standing while its economic dynamism slowly drains away. The stakes extend far beyond Russia's borders. Energy markets, regional security, and global trade networks all feel the tremors of Russia's economic shifts. Sanctions policy debates continue. Strategic calculations evolve. The world watches closely because Russia's trajectory affects not just one state, but an entire geopolitical balance. In the end, the story of Russia's economic crisis is a story of pressure. External sanctions, internal spending priorities, demographic shifts, technological isolation, and the heavy cost of prolonged war. It is a story of resilience mixed with fragility, of strength projected outward while vulnerabilities deepen within, of an economy that refused to fall quickly, but now confronts the far more difficult challenge of avoiding long-term decline. The question is no longer whether Russia can survive the immediate shock. It has. The question is whether it can reinvent itself under constraint, diversify beyond hydrocarbons and weapons, restore investor confidence, and rebuild technological bridges. Without those shifts, stagnation may harden into something more permanent. And that is the real drama. Not a single catastrophic moment, but a drawn-out reckoning. An economy once fueled by energy abundance and global integration now navigating isolation and militarization. A powerful state confronting the limits of fiscal stimulus and geopolitical defiance. The world sees the headlines, but beneath them lies a deeper transformation, unfolding month by month, budget by budget, barrel by barrel. Whether history will remember this period as temporary turbulence or the beginning of prolonged economic decline remains uncertain. But one truth is clear. Russia's economic story is entering a decisive chapter, and its outcome will echo far beyond its borders. In the end, the story of Russia's economic collapse is not one of sudden implosion. It is the story of pressure building behind closed doors. It is the story of an economy that absorbed shock after shock, defied early predictions of immediate ruin, and projected resilience to the world. But resilience is not the same as recovery. Survival is not the same as strength. Under the leadership of Vladimir Putin, Russia has redirected its economy toward war, restructured trade away from the European Union, and leaned heavily on energy exports and state intervention. These measures have bought time. They have stabilized the surface. But beneath that surface lies stagnation, mounting fiscal strain, technological isolation, demographic decline, and shrinking private sector dynamism. The danger is not a dramatic collapse overnight. The danger is something quieter, a prolonged era of low growth, declining real incomes, limited innovation, and increasing dependence on military expenditure to sustain output. An economy can continue functioning while gradually losing its competitive edge. It can remain intact while opportunity erodes. It can stand tall while its foundations weaken. And that is the crossroads Russia now faces. Will it pivot toward diversification, transparency, and modernization, or will it double down on militarization and resource dependence, accepting long-term stagnation as the cost of geopolitical confrontation? The answer to that question will define not only Russia's future, but the economic and strategic balance of Eurasia for years to come. History rarely moves in straight lines. Empires do not fall in a single day. They bend, they strain, they adapt, or they ossify. Russia's economy has proven more durable than many expected. But durability under pressure does not guarantee prosperity. The world is watching, markets are watching, its own citizens are watching, because this is no longer just a wartime adjustment. It is a reckoning, and whether this chapter ends in renewal or prolonged decline will determine how the story of Russia's economy is ultimately written.